What's up everyone? It's Sergey Yakimov, and in this video, we're diving headfirst into the world of investing, specifically, the mistakes you absolutely need to avoid as a beginner. Let's go over some investing mistakes to avoid if you are a beginner in the stock market or you're new to stocks. Look, the stock market can be intimidating, especially when you're just starting out. There's so much jargon, so many strategies, and it feels like everyone else already knows the secrets. Let me save you some trouble, let me save you some heartache, and let me save you some money. But don't worry, I'm here to guide you through it. In this video, I'm sharing the top 10 investing mistakes beginners make, so you can sidestep the pitfalls and set yourself up for success. Let's begin. Alright, mistake number 1 is a real heartbreaker, getting caught holding the bag when a company goes bankrupt. Now, you might think, who in their right mind would invest in a company about to go under? But here's the thing, sometimes it's not that obvious. A company might announce financial troubles, restructuring, or even layoffs, and these are often early warning signs. Now, I'm not saying every company that struggles is doomed, but if you see these red flags, and then the word bankruptcy starts getting thrown around, it's time to seriously reconsider your investment. Remember, hoping for a miracle turnaround is not a solid investment strategy. If a company announces that they're going bankrupt, you should run away from that stock. The writing is on the wall, and more often than not, the stock value goes to zero. Protect your capital and move on to more promising opportunities. Let's talk about those get-rich-quick schemes you see all over the internet, promising insane returns with penny stocks. Look, I get it. The allure of turning a few $100 into a fortune is tempting, but trust me, penny stocks are more like penny traps. These stocks, often trading for less than $1, are notoriously volatile and easily manipulated. You see, unlike stocks listed on major exchanges like the NYSE or NASDAQ, penny stocks on the over-the-counter market don't have the same level of regulatory scrutiny. This lack of transparency makes them a breeding ground for scams and pump-and-dump schemes, where insiders artificially inflate the price before dumping their shares, leaving unsuspecting investors with huge losses. Don't buy penny stocks from the over-the-counter market. Stick to stocks on reputable exchanges like the NYSE or NASDAQ. Remember, if it sounds too good to be true, it probably is. Now let's talk about those online stock market forums and message boards. You know, the ones that promise insider secrets and hot stock tips. While it's tempting to jump into these conversations, especially when you're eager to learn, I'm here to tell you, proceed with extreme caution. These forums can be breeding grounds for misinformation, rumors, and frankly, a lot of noise that can seriously cloud your judgment. Remember, everyone online has an agenda, and it's often not in your best interest. You might stumble upon a seemingly convincing post about a guaranteed winner, only to find out later that it was someone trying to pump up the price of a stock they already own. Avoid participating in online message boards. They are often filled with internet trolls and unproductive conversations. Instead of relying on the wisdom of the internet masses, focus on building a solid foundation of financial knowledge from reputable sources. Chapter 4. Day trading, not your get-rich-quick scheme. Alright, let's address the elephant in the room, the one you've probably seen all over social media: day trading. Now, I know it looks glamorous. Those fast-paced charts, the constant buying and selling, the promise of making a killing in a single day. But let me tell you, as someone who's been in the game for a while, day trading is not for the faint of heart, and it's definitely not for beginners. In fact, it's more like trying to outsmart professional race car drivers on your first day at the track. These guys and gals have years of experience, sophisticated algorithms, and access to real-time data that most individual investors could only dream of. If you are a beginner, do not try to be a day trader. It's a losing battle against professionals with sophisticated tools. Instead of chasing quick profits, focus on building a long-term investment strategy. Remember, slow and steady wins the race. Chapter 5. Timing the market mission impossible. Now let's talk about one of the most common investing myths out there: timing the market. You know, the idea that you can perfectly predict when to buy low and sell high, riding the waves of market fluctuations to maximum profit. Here's the reality. It's incredibly difficult, even for seasoned professionals, to consistently time the market correctly. Don't try to time the markets. Instead, use a staggered approach to invest systematically over time. Instead of trying to predict the unpredictable, Consider a strategy called dollar cost averaging. With dollar cost averaging, you invest a fixed amount of money at regular intervals, regardless of the market's ups and downs. This approach helps you average out your purchase price over time, reducing the impact of market volatility on your portfolio. Remember, time in the market is often more important than timing the market. Chapter 6. Don't ignore the big picture. Pay attention to the general market. Alright, here's a mistake I see investors make all the time. Getting so caught up in individual stock picks that they forget to pay attention to the overall market. Look, the stock market doesn't exist in a vacuum. It's influenced by a whole bunch of factors like interest rates, inflation, economic growth, and even geopolitical events. Ignoring these macroeconomic trends is like trying to navigate a maze blindfolded. You might stumble upon a few correct turns, but you're more likely to get lost along the way. Pay attention to the general markets. Compare your performance to the overall market to gauge your success. Keep an eye on major market indices like the S&P 500 or the Dow Jones Industrial Average. These indices provide a benchmark for how the overall market is performing, and by comparing your portfolio's performance to these benchmarks, you can get a better sense of how well you're actually doing. Let's talk about dividends. Those lovely cash payments that companies distribute to their shareholders. Now, a high dividend yield, the annual dividend payment as a percentage of the stock price, can be tempting, but it's crucial to remember that not all high yields are created equal. In fact, some can be downright dangerous. If a company's dividend yield seems too good to be true, it probably is. These companies might be facing financial difficulties or have unsustainable business models, and that high dividend yield could be a red flag that they're struggling to attract investors. Be cautious of stocks with too good to be true dividend yields. They often slash dividends or plummet in share price. Instead of chasing yield, focus on companies with a solid track record of dividend growth and a sustainable payout ratio, the percentage of earnings paid out as dividends. Alright, let's talk about one of the most fundamental principles of investing: diversification. You've probably heard the saying, don't put all your eggs in one basket, and nowhere is this truer than in the stock market. Diversification means spreading your investments across different asset classes, sectors, and geographies to reduce your overall risk. Think of it like building a well-rounded breakfast plate. You wouldn't just have a plate full of bacon, right? You'd want some eggs, maybe some fruit, and perhaps a little toast for good measure. The same logic applies to your investment portfolio. Diversify your investments. Don't go all in on one stock, no matter how solid it seems. By diversifying your investments, you're essentially hedging your bets. Now let's talk about a concept that often gets overlooked by beginner investors: trading volume. Trading volume refers to the number of shares of a particular stock that are traded over a given period. It's a crucial indicator of a stock's liquidity. Essentially, how easily you can buy or sell shares without significantly affecting the price. Pay attention to the trading volume of a stock. Low volume can trap you in a stock, making it hard to sell. Investing in stocks with low trading volume can be risky. Imagine trying to sell a rare antique vase in a small town. You might struggle to find a buyer willing to pay a fair price. The same logic applies to low-volume stocks. You might find it challenging to sell your shares quickly or at your desired price, especially if the market takes a downturn. Alright, before we wrap up, let's talk about one of the most important financial safety nets you can have: an emergency fund. An emergency fund is a stash of cash set aside to cover unexpected expenses like medical bills, car repairs, or sudden job loss. Ensure you have an emergency fund before investing. Without it, you might be forced to sell stocks at a bad time. Without an emergency fund, you might find yourself in a situation where you're forced to sell your investments at the worst possible time, during a market downturn, to cover unexpected costs. This can seriously derail your long-term investment goals and lead to costly losses. Aim to have 3 to 6 months' worth of living expenses saved up in a readily accessible account, like a high-yield savings account. Having this financial cushion will give you peace of mind and prevent you from making rash investment decisions during times of financial stress. I hope you enjoyed these investing mistakes and learned something valuable. Remember, investing is a marathon, not a sprint. By avoiding these common mistakes, you can set yourself up for long-term success in the stock market. If you want to get started in the stock market, Check out our other videos and use our affiliate link below to receive free stocks. We cover everything from fundamental analysis to technical analysis so you can make informed investment decisions. Thank you so much and please subscribe and take care.